As Wall Street digests today's dismal jobs report, what do the numbers mean for the economy going forward? Scott Brown is the chief economist at Raymond James Associates and a Bloomberg best economic forecaster. He joins us from St. Petersburg, Florida. Scott, welcome to Bottom Line. Always a pleasure to have you on.
Nice to be with you.
Scott, a day after that euphoria following the better than expected ADP number, what happened, and does troubling adequately describe today's data?
Well, certainly the markets have been head faked by the ADP numbers in the past. I think they probably took yesterday's numbers a little more to heart than they should have. This was a disappointing number, but I don't think it was a complete disaster. If you look at the last 2 months in the private sector, we've averaged 65,000 monthly gain, but that followed a 240,000 average for February, March, and April. So it may be the case that the seasonal increase that we normally get in jobs may have just been shifted forward a little bit. So it makes the earlier numbers look stronger and the more recent numbers look weak. If that's the case, then the numbers are nothing to worry about. But even still, if you look at the government sector, that's being a drag on growth. It's another serious headwind we have to face. State and local governments subtracted another 25,000. We had a drop in federal employment. And this idea of austerity, it's good in the long term, but in the short term, it's not going to help the recovery. But it makes the recovery slower.
But Scott, if I might jump in there, because however way you slice it, this economy is just not making jobs. Jobs are not being created.
They are being created, but not at the pace we'd like to see. We have seen job growth over the last year or so, but it's been disappointing relative to where we've come from. A lot of people look at the unemployment rate, and I think a better gauge is the employment population ratio. And that's been either steady or trending a little bit lower over the last year. So even though the job growth, we are seeing positive job growth, that's the good news. The bad news is it's nowhere sufficient to push the unemployment rate down.
But Scott, your point having been made, even as our Lizzie O'Leary mentioned in the prior segment, when Americans hear that 14 million of their friends and neighbors and family members are out of work and they can't find jobs, what you just said is of little comfort to them, wouldn't you think?
Exactly the case, but we knew all along that this was going to be a very gradual economic recovery. I mean, this is not your father's recession. This is your grandfather's depression. When you look at recessions that are caused by financial crises, they're much more severe, they last longer, and the recoveries really take a long, long time. The Fed certainly has done its part supporting growth. The fiscal stimulus, I don't think, was really strong enough or effective enough to do its job and propel the economy more rapidly forward. But now that fiscal stimulus is now turning around, and it's becoming a drag on overall growth. And that's a bit of a concern, I think, as you look to 2012.
And Scott, you just mentioned the Fed. What do today's numbers signal for the Fed and for interest rates?
Well, not much. I think, we had Fed Chairman Bernanke speaking at the press conference following the last Fed policy meeting, and the Fed is essentially handcuffed here. It would like to do more to help spur job growth, but it really has to keep an eye on long-term inflation consequences of that. Now, we have seen overall inflation higher due to food and energy. Core inflation has also been trending somewhat higher this year, right at the Fed's comfort range. So it's a lot different situation than it was a year ago when inflation was trending lower, inflation expectations were trending down. There it was a clear case for the Fed to do another round of quantitative easing. The Fed can't make that case right now.
Scott, Wall Street clearly did not like what it saw today from those jobs reports numbers. All of the major indices, as we've been reporting all day, are in decline. But it's been a different story for the bond market. Why do you think that is?
Well, the bond market, I think, had been fearful that this slow patch may end up being more temporary than thought. We've seen some mixed economic readings. You had the resolution, or at least a short-term resolution, about the situation in Greece, so that took one worry off the table. And you look at the stock market the last couple of weeks, the market's been ignoring the bad economic news and embracing the good. Well, the numbers we had today were pretty hard for the stock market to ignore. But that in turn is good news for the bond market. A softer recovery, it pushes out a possible Fed rate increase. Many people were looking for the first rate hike to come in the first half of next year. I think most people would probably push that well into the second half of next year.
Scott, if I could ask you in our final 30 seconds, even with today's disappointing numbers, are we going to see improvement in the economy in the second half of the year, or are the numbers an ugly indication of what's in store?
Well, I think we are going to see improvement in the economy in the second half of the year. The bad news is that it's not going to be especially strong. We don't really see growth growing more than 3% through the remainder of the year. 3%, if we're lucky, I think, probably in the 2.5% range in the near term. Maybe getting towards 3% by the end of the year.
Yeah.
But there's still a lot of headwinds. So you have housing, which is still a drag on the economy, state and local government, which are running contractionary policy, the fading federal fiscal stimulus. Gasoline prices have come down. That's a little bit of a plus, but they're still relatively high.
Yeah.
The chain store sales results were positive, but there is some positive momentum here to build on.
All right. Our thanks to Scott Brown, Raymond James and Associates, joining us from St. Petersburg, Florida. Scott, thanks so much.